It's time for a change. Welcome to the brand new video series Market Maker Mastery 2025. If you want to know how the markets really work beyond mainstream knowledge, then you've come to the right place. In this series, I'll show you step by step how to understand the mechanics of the market and use them to your advantage. No secret groups, no fake signals, just real knowledge and real analysis and real results. So be sure to stick with us until the end of this series because you'll not only understand why the market moves, but also where it's most likely to go next. Let's start with the basics. How does the market really move? Before we dive into the material, a quick note. This format provides basic knowledge about the markets, an A to Z guide, so to speak. If you want to delve deeper into the subject matter, I'll also link to our free trader workshop below the video. But everything you learn here is based on understanding the smart money perspective. That means the big institutions that move the markets and how we traders can use that to our advantage. Put simply, the market does one of two things. It either seeks liquidity or it returns to a fair value, also known as rebalancing. These two phases occur in cycles. So there is no fixed order here, both are equally important in principle, but what does that mean in concrete terms? What does seeking liquidity mean? When the market seeks liquidity, it actively seeks buyers or sellers to enter the market so that the major market participants, such as banks or institutions, can place their huge positions. Because one thing is clear, large institutions cannot simply click on buy or sell and place a position in the market like we can do. No, they always need a counterpart, and that is precisely why there are these sideways phases, these consolidation phases in the market. A simple example, a central bank, a large hedge fund or a large bank wants to open a short position with a volume of several $1 million. To do this, they naturally need buyers on the other side who can raise this volume of several $1 million. These buyers cannot simply be found in the market, but there are algorithms that these large institutions use to move the market in a way that is advantageous for them. They build up their position in the market over a longer period of time, so to speak, in order to then place the large position here accordingly. And afterwards, we often see movements in the corresponding direction. And it is precisely this manipulation that we often find in swing highs and swing lows. It's simply a previous high or low in the chart. Why is that? Let's take a look at the sideways phase. Well, most traders who are short here protect their position somewhere above the next high. And if the price now goes down, either new traders open short positions or those traders who are already short here protect their position above the next high. And this is precisely why we see time and time again that these highs are taken out of the market just so that the price can continue in the corresponding direction. The same is true in reverse. Once a high has been broken, many think that there will be a change in the trend, and these traders then protect their position accordingly, either below the next low or generally below the low. And that is exactly the liquidity we are talking about. This area here is, so to speak, the liquidity pool where smart money accumulates its orders. We are talking about a period of several months from November to March, followed by an explosive upward movement. So to understand these market movements, we need to clearly define what liquidity means, whether it's Forex, futures, cryptos or stocks. It always takes a buyer and a seller to make a trade possible in the first place. And what does this mean for large institutions? As already mentioned, as normal retail traders, we can simply click on buy or sell and trade the market accordingly. Large institutions naturally need more time. This means that these sideways phases are repeatedly used to accumulate orders. That is why we are talking about consolidation or sideways phases or even an accumulation phase. This consolidation now serves two purposes. First, there are traders who see this range here and trade a breakout. What does that mean? If the price now goes down here, these traders speculate that the market will continue to move downwards in the corresponding direction. And if the price breaks out upwards here, These traders speculate that the market will move upwards. As a result, buy stop orders accumulate above these highs and sell stop orders below these lows. This means that these orders can be found above and below this range. This in turn means that these price levels below and above the range are those where the most liquidity can be found, where smart money, where the large institutions can bring their orders which are not yet in the market in this sideways phase into the market for the final push, so to speak. And we see time and time again that both sides are then stopped out. This means that we should take note of this pattern of sideways phases, fake runs and expansions in the opposite direction. What exactly happens when such a liquidity pool is reached? Well, traders who have bet on short positions here will of course be stopped out, as will traders who see a support zone here, which means that smart money can open its position here and go long in the market. This means that traders who were short will be stopped out. They sell involuntarily and smart money can collect the orders here and buy cheaply. What happens here is exactly the opposite scenario. Traders who have protected the short position above its swing high then buy above it involuntarily. This means that they must of course buy back their short positions, and smart money uses this on the other side to close out the position they bought here at a profit. The result is there are suddenly enough sellers in these areas that a long position can be opened here for the big players in the market, and at this point there are enough buyers who buy this position from smart money at higher prices. This means that, as you can see, the market is often an interplay between uninformed traders who sell cheaply and buy expensively, and the informed, or the smart money as it's often called, who buy at low prices and sell again at higher prices. And that's exactly where we want to be, where we want to trade. So the market moves from liquidity point to liquidity point, and all we as traders basically have to do is to locate these liquidity points, these liquidity pools. And if you know where this liquidity is, then you know also where the market is very likely to go next. But what does it now mean to offer a fair value or rebalance the market? Now that we know how the market seeks liquidity, the next key mechanism comes into play, namely the fair value gaps in the market. So what does this actually mean? Imagine the market is moving strongly upwards in one direction as shown here. In this case, buyers in particular had the opportunity to enter the market. We call this inefficient price behavior. That is why we also refer to this blue area as inefficiency or fair value gap, because the market tends to return to these inefficiencies as we see here, and we observe a typical pattern here. The market moves upward, the buy side is taken out of the market, buy stop orders above these relative equal highs, then the setback follows. Now the sell side comes into play, the sellers so to speak, and the market returns to this fair value gap. This is the zone where the market comes back, and we have to watch closely how the price behaves afterwards. A very simple but powerful tool is this 3-phase system, in which we identify a movement, the correction, and the continuation. Now, that in itself is nothing special if we are bullish overall. However, we very often see the market coming back exactly to these inefficiencies. That means we see the following in the chart. We have this inefficiency here in the market, a fair value gap, and the market is forming a small sideways phase. So if we now fast forward, we see that the market is already shooting up here, but still leaves this inefficiency open. So we see our concept of liquidity mentioned earlier. Buy stop orders were taken out of the market, and this inefficiency still lies beneath us. That means now, if we are bullish, we don't just want to jump into this market with a buy. No, we simply have to be patient here until the market has balanced out these inefficiencies. And we see the last one here in this area with this upward price movement. That means we can place our order in this area, and then in a bullish market environment, as we will determine later in this series, we expect the upward trend to continue, and then the market comes back we see exactly how this inefficiency is closed, and accordingly the upward trend will continue. However, if the market does not respect this inefficiency and breaks upward, then we expect the price to return to the liquidity and go to the next buy stops above. If, so to speak, this box here, this fair value gap, this inefficiency is not only closed and respected as here, but broken, then it is very likely that the price will move into the next liquidity pool above the next high. Why is this important? Well, if we look at the market here and can identify these inefficiencies in the price movement, as can be seen very clearly in this case, then we will learn later in the series that it's important not just to blindly trade a time frame here or blindly place a trade here, but we will see now the interaction of several time frames and also fundamental data to help us to decide whether we can place a trade here or not. For the beginning, however, it is enough for us to observe whether we see a reaction here or not. And here we can answer that very clearly with yes, and accordingly we can expect the movement here to the next significant price point, in this case the actual overnight gap. What happens next? We see a clear reaction here and back into this inefficiency, into this fair price range, so to speak, or in this fair value gap. And here too we see the market reacting again. And what happens now? It closes this gap for now, but leaves behind another fair value gap. This means that if we now expect the price to rise above the next high or above the liquidity pool in this case, because our fundamental data, because for example the higher time frame would recommend this, then it's time to closely observe this fair value gap, this inefficiency. And we see that it's closed exactly and respected throughout. And these are precisely the things in which we then expect the price to rise to the next liquidity pool, to the next buy stops. And that is exactly what we see here in this case. This inefficiency, this fair value gap, is closed and respected. The price comes back again, almost touching it again. So you see, these are the real support and resistance zones in the market. These inefficiencies, these fair value gaps. And with the right context and the right overall bias, we can find these exact trades. Now let's do a quick reality check. We are always dealing with probabilities here. Nothing is 100%. And if we look at this price movement and see which fair value gaps would have held, we would have had a successful trade from this lower range. Obviously, this fair value gap also played out. However, we also see that we have a fair value gap in the market that has been broken downwards. That would be on the negative side, so to speak. If we continue here, we see that several small fair value gaps did not hold in this case either. And this brings us to a crucial point, namely that liquidity and fair value gaps must always work together. We see here that in this example, the market is taking liquidity out of its low and then a fair value gap emerges. Now, in this case, it holds. With this fair value gap, we see that the market did not stop out a low here, and in this case, did not hold here afterwards, but rather the market regained an inefficiency at a low, and only then did the rally follow. Here too, we see that no low has stopped out before, and the rally followed afterwards. In summary, this means that we must understand liquidity and these inefficiencies, this rebalancing in the market together in order to find successful entry points here. And that's exactly what the next Market Maker Mastery 2025 video will be all about. How we first overlay these concepts and how we also get a context, an overarching bias, so to speak, an overall direction in the market by overlaying 2 or 3 timeframes, so that we don't have to grope around in the dark when entering trades, but can trade with a plan and structure in an overall direction. So be sure to subscribe to the channel so you don't miss these upcoming videos. If you liked the video, please give it a like, and if you want to dive deeper into the subject matter right away, such as how we use our fundamental analysis tools, I can recommend our free workshop linked below the video. Click on it and I'll see you there.